This week's edition of Landlording for Life is brought to us by our good friends at Audible.com. Go to audibletrial.com/landlording and preview over 180,000 titles. At the same time, get a free audiobook download and free 30-day trial to all of our listeners. Now on to this week's podcast.
This is the Landlording for Life podcast, where landlords explore their success and stories of failure while building a foundation to improve upon. Here is your host, Sean Morrissey.
Hey everybody, welcome to another edition of Landlording for Life. Thanks so much, as always, for checking in with us this week as we bring you another podcast episode. And what we're going to talk about is cost segregation. In fact, we're going to dive in a little bit as to what cost segregation is, how you can use it as a tool going through the rest of 2020. And in order to do so, we brought on with us really an expert in that field. Her name is Linda Martin-Schumacher. She's the National Director at Cost Segregation Services, or CSSI. And she's going to go over with us what we can learn about what cost segregation is and how we can implement it as a tool moving forward. So, Linda, welcome to the podcast.
Thank you, Sean. Glad to be here.
You bet. You bet. So, Linda, tell us a little bit about yourself, what attracted you to cost segregation, and what you're up to these days as a career.
Well, in 2008, I was working in the medical field with different surgery centers, little docs, big docs, and I saw how they were struggling just financially. And then I saw doctors that were flourishing. And I think the beautiful thing is they were flourishing because they were utilizing cost segregation to build their practice. And that's how I understood in 2008 what cost segregation was. Talked to a friend who was involved in it, started studying engineering and tax law, and I'm not the sharpest crayon in the box, but it was interesting to me, so I kept studying it. And then my very first encounter was when I was with a doctor who owned 3 cancer centers, and I asked him, "Doctor, have you gotten your tax benefit back yet on your building?" And he said, "No, what is that?" And I said, "Cost segregation." And he said, "Wow, can you tell me what my benefit would be?" And I quickly ran back to the office and called the company, and I said, "Can you provide an analysis for me for this doctor?" And this was really my maiden voyage in cost segregation. Within 2 days, they gave me an analysis back that said this doctor was going to make over $900,000 in the tax savings benefit. We've completed the study. He made after the final results, probably a little less than $1 million. When I brought him the final study, I said, "Hey, Doc, what are you going to do with this money?" And he said, "Build a 4 cancer center." So that's how I saw not only it's saving businesses from going under, but it also allowed them to build their business and expand.
Yeah, and it's interesting that you got into it almost by happenstance in a way, but through the medical industry. And man, to see somebody achieve that much tax benefit, it's almost like a no-brainer. Like, now that I've seen this, why not dig deeper and find other ways to help other folks in in different commercial industries? So before we dive in too deep, give us a little general overview as to what cost segregation is in relation to real estate investors in general.
Sure, I would love to. And I don't want to minimize the fact that, some of the most excited people about cost segregation are some of the, small investors who are getting $20,000 back. To them, cost segregation is much more lucrative than the person who got $1 million back. Sometimes people are more excited. But CSI, Cost Segregation Services, is an engineering-based cost segregation firm. So we were founded in about 2001 by an engineer called Jim Shreve, who worked on a landmark case at the Supreme Court with the Hospital Corporation of America. There are 250 hospitals in the 90s that owed the IRS $800 million, and they were absolved of their $800 million debt. And when that happened, everybody started racing to do cost segregation, and the courts came back and said, "Wait a minute, Judge, we don't want just anybody doing cost segregation. We would like an engineered report. They know what's in the ceiling and the floors and in the walls. They understand the numerology and the accounting of it and the assets. So that's the preferred method of a report that we want to see.
Okay.
So that was really the birth. That was the birth of CSSI, but it's really important to note since 2001, not one report has ever been thrown out by the IRS. We've done way over 20,000 studies. Any of projects can range from 200,000 to a billion, whatever. The skyscrapers in New York. But, when this all happened, we recognized that CPAs did not want the liability. And because the law is constantly changing on how and what the courts want and IRS wants in a study, we have to constantly change with those laws and rules. And so that's why CPA firms, small and large, want to use us because they know we accept all liability. If the study is ever questioned, we appear on our own nickel to defend the study, and that's what everybody wants to hear.
Okay, so the engineers that work for CSSI, what exactly are they performing? Are they actually breaking down, like in a building, all the personal property, all the personal fixtures, and then trying to evaluate that based on like an accelerated depreciation schedule, or how does that shake out?
Beautiful question. So if you have $1 million multifamily apartment, you have two choices. You can depreciate it over 39 years, and to the IRS, that's looked as a 39-year chunk of property. Or you can do the accelerated method called cost segregation, and then they break things down into a 5, 7, 15-year property. 5-year would be considered assets like carpeting, laundry equipment, dedicated plumbing for laundry, dishwashers. 7-year assets would probably be furniture, fixtures in the management office. 15-year assets are your landscaping, paving, sidewalks, striping, curbing, specialty security lighting. So they break out all these assets into 5, 7, 15 years. And then you still have your 39-year category, which is your brick and mortar, your roof, your ceiling systems, doors and frames, electrical, elevator possibly, the windows, the HVAC. Those are the 39-year items. But the beauty of cost segregation, Sean, when you do a cost seg, you're going to get an initial tax benefit. So if you have $1 million multifamily built apartment, you're going to get anywhere from $50,000 to $70,000, possibly $80,000 back per million. So everyone thinks, oh my goodness, this is wonderful. I can use this money, I can buy another apartment, I can buy more property, I can do this. But where the beauty is in the report is for years to come when they're faced with a repair and renovation. And we're going to hit that possibly down in a few minutes with another question of yours. But that is the most important part of cost segregation. Okay.
No, I love that rule of thumb. It's anywhere from, what was it, 50 to 80,000 per $1 million of building value.
Right. And a warehouse wouldn't have that many assets, moldings and flooring and decorative items.
So that'll be in the lower end.
So apartments generally have those nicer finishes.
Yeah, got it. Okay, so at the end of the day, cost segregation is a way for investors to take advantage of an accelerated depreciation schedule on some personal items that are tied to the property itself. But who's cost segregation best suited for? Who do you see as your typical client?
Well, according to the IRS right now, all of their regulations are built around the cost segregation model. So in 2014, there were the final tangible property regulations, and those defined what an owner, whether it's a commercial or a single-family home or a multifamily home investor, that defines what they can expense and what they have to capitalize. And those are really laws and rules and regulations that the CPAs had a hard time getting their arms around too. So those regulations, and now the Tax Cut and Jobs Act, I can't even tell you how that's invigorated this world and this economy. Just from, Franklin Park that was almost, deserted has now been invigorated by new commercial growth.
Yeah.
New apartments, people are buying and selling, and the 100% bonus depreciation that came out of the Tax Cut and Jobs Act. Now, what I told you, you're going to get 50 to 80% back in a $1 million purchase. Now that's almost double, because any assets that are considered a 20-year class life and less get 100% bonus on it. So now you're almost doubling your tax benefit. And that is really spurring the economy to for people to buy more property. If they don't, then they use it to go on vacation or more employees or equipment, whatever they want. But it gives people more cash flow.
No, yeah, I think that's well said. And you know what? And the other thing, I mean, the way you made it sound is really cost segregation, because of the Tax Reform Act of a few years ago, is really for anybody that holds commercial property. But I tend to find that it might be best, and tell me if I'm wrong, but I tend to find it to be best for those high-income W-2 earners that are being taxed to holy heaven and then ultimately own commercial real estate, and they're not getting the full taxable benefit for that because of the fact that they don't have, the real estate professional designation. So they're able to now use cost segregation and even bonus depreciation to accelerate their tax savings, so they're not taxed nearly as bad as they used to be. Is that fair to say?
That's fair to say. I think the new regulations, though, with apartment owners, multifamily owners, there's more. You need to be more compliant. They're not letting any more gray area fall with apartment owners. There's one situation that's come up is, and we provided seminars on this for CPA firms, who calls himself a real estate professional. That is really, you have to really watch that. That's the number one area being audited right now by the IRS. A doctor who's got a lively practice is calling himself a real estate professional too, so that his income is being offset by the rentals. You can no longer do that. It's there's just no more leniency in this area. So you have to be really careful if you're calling yourself a real estate professional.
Yeah, absolutely. So when we talk about average cost of a cost segregation analysis, and I know it can be different between, CSSI and other engineering groups out there that perform this type of activity, but what do you say is roughly the average cost that someone might see? Is it dependent on the purchase price of the property or the number of personal items within that property that could be depreciated, or?
Awesome question. So it makes sense that a cancer center with specialty wall board between their radiology equipment and the specialty paint on the walls, they have many more assets for the engineers to identify and classify, and it's going to be much more of a timely process than a warehouse with concrete and rubber moldings. So the price really is a time factor. When I recently did a hospital, that was, monumental. And then since the engineers are taking the liability for the study, they take a little bit more time involved because, they have to, it's their rear end's on the line. So it's really important that the studies can take 6 weeks sometimes to complete. But they stand by them. And so the price is always different. And so I've been with CSSI now for over 10 years. And I generally don't know. I know in a line where it might be, but it's not very expensive now. It's come down. It comes down every year. I hear CPAs. This is a scary thing. I've heard CPAs tell their clients, "Oh, cost seg, you don't want to do that. That's too expensive." Well, it's not these days. For instance, I have one little small Coldwell banker that fixed up a house in the middle of town, and they spent maybe $240,000, $220,000, and she got, because of the finishes inside, she got a little under $22,000 for her tax savings benefit. And she was thrilled with that, and I don't even think it cost her $1,900 to get $22,000. So that is a small example.
Well, that's funny because, just using that example, that's like a 10-time savings. So it cost her, roughly $2,000, but she saved $20,000. So that's
right.
That's pretty well justified. Is there like a rule of thumb that for the cost of the segregation study, you might save 10 times in tax savings, or is that? I
think it's 10 plus.
Really? Okay.
I've had studies just completed within this week for for different commercial locations, and they probably get over $100,000, and it costs them $5,000 or $6,000 to do the study.
Man, I love it. Okay, very good. So that's all good value right there you're providing the listeners. Thank you for that. What about what a investor should be looking for in a cost segregation company? I mean, it's funny. It's going back probably about 18 months ago, but I was approached by somebody who told me, hey, Sean, call this engineer. They'll do a cost segregation study. And ultimately, they were like doing it on the side out of their house. And I found it to be a little bit strange. But at the end of the day, I wonder, are there rules of thumb that someone should go by when it comes to evaluating cost segregation engineers?
That's a great question. So there's guidelines written on what I believe the 13 principal elements of what a quality study would contain. And basically it's a preparation by an individual who's got expertise and experience like an engineer would. And then it's the description basically of the methodology used. They want to know what kind of documentation is presented. If you had interviews conducted by appropriate parties, which I want to tell you in a second about, there's a standard numbering system and an explanation of legal analysis. And if you've taken a certain area and classified it as an asset, you have to attach a chief ruling and regulation on why that was done so. So a lot of legal added, to why you're doing, what you're doing in the report. Reconciliation of the total allocated cost. And you have to explain the treatment of the indirect costs. And you're identifying and listing, 1245 property and 1250 property. So it gets to be pretty crazy.
Pretty detailed, yeah.
Yeah, and so always a site survey is conducted, boots on the ground, to determine if you can uncover something. If I have 2 seconds, I got to tell you two situations.
Yeah.
Where in Boston, there was a large building, used to be an office, and then it went to condos, and then went to apartments. And walking with the maintenance man, he started to react about how the decorator had painted over this beautiful mahogany wood with white paint. And that, just interviewing him, that gave them another $300,000 for tax benefit. Just the mahogany that was uncovered.
Is that right?
So, yeah, and then I've got to tell you, a little downtown Plainfield, there was it's from the 1800s, and the Caldwell banker took it over for an office. And I went over there to do on this little location, and all they owned was the build-out. They didn't even own the building. So I went in there, and I found a 100-year-old crane in the closet.
Okay.
That had, and that could be accelerated. That was an asset that they owned. And then in Naperville, a bike shop took over an empty bank in a strip mall. And I went in there, and they had a vault. I was like, oh, my goodness, you guys don't understand the money here.
Yeah, those things don't come cheap.
So you have to go in and see the assets and see if you can identify specialty items. I love dentist's office, and this is why multifamily, they have specialty plumbing for extra and things that can be accelerated and benefit financially an owner because there's specialty plumbing for laundry, so forth.
Okay. All right. Very good. Are there any specific designations that an engineer has to hold in order to perform cost segregations? I've wondered that as well.
Some specific,
like certifications or designations they need to hold, or a license they need to hold in order to be a cost segregation engineer. Do you know it all?
I don't know if it's a certification. I think it is a preferred method that an engineer does it. I've known some CPAs that have done cost seg, and we have identified, and it's an industry knowledge, that you can get 35% more with an engineered study than if the CPA does it. Because the CPA really doesn't know what's inside the walls and the floors and so forth.
So, Linda, tell us a little bit about the final regulations that were authorized back in 2014 towards pads or pad disposition.
Well, a pad now according to the new regulations, has to be taken per the IRS in the year it occurs. In the past, they would let you go back several years and figure out that you threw something away from a repair or renovation. But the new regulations are very, very difficult, but at some minimal level, everyone needs to understand how that evolves. So let's say that you throw away 100 windows in your building, and there's 300 windows total. Those windows haven't fully depreciated yet on your depreciation schedule. You're throwing away dollars in the dumpster. So the IRS wants you to identify the value of what you're throwing in the dumpster. Then you also get removal costs and labor, because you have to hire the people to take it to the yard. You've got to buy the dumpster. So all those costs get to be written off in the year it occurs. It's a use it or lose it. You got to take it in the time frame that it's done. So these really strategic. Look back at the end of the year and see what was thrown away. I don't care if it was a little tiny compressor in your HVAC unit. That little compressor probably is worth $5,000. You have to know these things, or at least bring them up to your CPA so they can find out the value and do the calculation for you.
Okay.
Go ahead.
Go ahead.
The tangible property regulations, it's so important. They're probably one of the biggest changes in our tax law. And compliance is really important. They want you to look at your depreciation schedule, and they want you to do what's called a scrub it. And they want you to identify items that now are on your depreciation schedule that were capitalized. Because in the past, CPAs overcapitalized because they wanted to play safe. Well, now the IRS says that's no longer tolerant. You have to look at those items, and they now can be reversed and expensed, which is going to give you much more cash flow. And you know why that's critical? My brother owns 16 apartment buildings, and he does a lot of 1031 exchanges. Number one thing he said he doesn't want to do, if he throws something off, he wants to get it off his books, because if he doesn't, he's going to face recapture down the line when he gets rid of the apartment building every 5 years. So he wants to make sure he does a pad. Also, he wants to look at his depreciation schedule and make sure that they're not capitalizing something that should be expensed. So those are critical ways that multifamily investors build their business. They know these laws in some minimal fashion. And then there's also something called the safe harbors. And the safe harbors give you, the de minimis safe harbor gives you a $2,500 deduction, and you have to have an invoice, not a penny over, anytime. So if you have $2,500 expenses, you can take care of those. And you need to be strategic when you face a repair or renovation. I had an apartment building, and I probably used the 100 window example. He replaced 100 windows that were cloudy and looked bad because the sun had faced that part of the building. And he thought he was going to have to capitalize that expense, and he ended up being able to expense it. I've had gentlemen that have called me with roof repairs. You know, they've done shingles and flashing and so forth. And the first question you have to ask yourself, was this a total new roof? No. So you were just keeping it in normal operating condition and replacing it with like-kind materials? Yes. Well, what was the cost of that repair? Well, it was around $33,000, and his roof was valued at $100,000. So as long as it's around 30 to 35% of the value of that component, the roof, he got to expense it. Now, if he had paid $40,000, that's over the threshold. You have to capitalize it. So these are things you should ask your CPA. Am I maximizing my tax return, first of all? Do I have my, is there any money to squeak out of here in cost segregation? Is there possibly a pad I can take from this repair or renovation? And am I maximizing all there's something called a repair or routine maintenance safe harbor.
Okay.
If you routinely expect to do a reoccurring activity on your property, every 10 years, you have to do that same activity. That pretty much is a write-off. And everyone wants to keep their property up because they want to get to the next big property, or they want to keep it occupied. So this really allows you to keep your property up, expense these items. So routine maintenance is very important. It's one of the least taken because people are not sure of it. And so there's also something called the Rabbi rules.
Man.
And this very briefly.
Yeah, go for it.
So
There's a lot of content here, but yeah, go right ahead.
The IRS says you have to look at an invoice, and if it meets one of these Rabbi rules, which is, is it a restoration, this invoice? Is it an adaptation? Or is it a betterment? Or is it an improvement? And you say, is this invoice now, hey, restoration, did I restore something to its natural, in a bigger, better way? No, I just kept it in normal operating condition. Okay, is this an adaptation? Did I change this to a drive-through? No, I didn't adapt it to a new. It's still the apartment building. Okay, did I better it with energy efficient, things that are so much more, productive? No, I just like kind material. And did I restore it? So you have to look at these things before you decide expense or capitalize. And this is what your CPAs are doing in your behalf right now to make sure you're in compliance with these new regulations.
Well, and I tell you what, again, there is a ton of information there just in the last few minutes. And it's one of those things where I think it's important for listeners to know that instead of just going out there and taking action on this, consult your CPA or call your office, speak to you personally for a better explanation. This is really meant to be a general overview, but not for folks to take action tomorrow. To talk to a professional first. But wow, lots of good stuff there. So let's talk a little bit about CPA and what kind of CPA we should be looking for when it comes to those that are friendly towards cost segregation. Because in my personal opinion, I look back and I think I've had CPAs that I would say are like, I don't want to do that much work. Cost segregation to me just sounds like more work for a CPA. But I guess, would you have any tips for us regarding the types of CPAs that are the most friendly towards cost segregation?
Well, the beauty of it is that CPAs are becoming, or they have become, so understanding of these regulations, that the tangible property regulations in 2014 and the Tax Cuts and Jobs Act are all centered around the cost effect study. Now, CPAs do understand one really crazy situation. Businesses being won and lost around cost segregation. If that CPA is not recommending or looking, for all the tax possible benefits for you, then somebody else is going to suggest cost segregation to their customer. So CPAs don't want to lose a lot of business. So they also have what's called a Circular 230, which they have to tell you all the possible benefits that you have at your advantage, and let you decide if you want to go forth with that. Bonus depreciation. This is funny. Bonus depreciation from the Tax Cut and Jobs Act is mandatory unless you elect out. So CPAs, when I meet with them yesterday, I met with a CPA and he said, Linda, there's 75,000 pages of IRS law. 1,000 pages so well of these regulations. And that's why we almost need you to be our back office. So they send over their clients' depreciation schedules. They actually blacked out the person's name, sent me the building's depreciation schedule. It wasn't their tax returns. It was just the depreciation on the building. And they sent it over to me, and they said, make sure we had maximized this client's tax return. We want to make sure that there's not a dollar left here that's not received by them. So I mean, they're doing their due diligence. That's awesome.
Yeah, I mean, and like you said, at this day and age, if a CPA is not performing cost segregation or they're not friendly towards it, they're just going to lose business because of it. So maybe it's as easy as asking that CPA, how many cost segregations did you complete in the last year, and then make your decision from there. But what about time frames to actually perform a cost segregation analysis? So, for instance, if I've owned a multifamily building for 5 years, is it too late for me to start a cost segregation study at that point? Do you need to start it within the first year or two of ownership, or how does that shake out?
Oh, I think it's like about 14, 15 years, because what happens is, yes, the 5, 7, 15-year assets have all depreciated. But what we find is on the depreciation schedule, they've had repairs, they've had improvements that are quite large. So they've had these improvements, and now we can do cost seg on those. So you always should have your depreciation schedule, as the IRS says, scrubbed to make sure that there's nothing left there to get.
Okay, perfect.
You brought up something else really interesting.
Okay.
In 2010, 2014, there were different bonus applications. And so we look back, and sometimes we'll see on the depreciation schedule, oh, you didn't take the bonus in this year. So that's, we can go back and grab that. So there's a lot of different laws that we have to go back to that time period and apply to that year.
Okay, fantastic. So what do you typically need from an investor in order to give them a cost segregation study, or at least a general overview to see if it's going to be worthwhile? Like, here's what it's going to cost you to have the study performed, but these are the anticipated tax benefits they'll provide.
I love that part because it's so simple. We have analysts in CSSI. If you would have the building occupied for some time, all we need is your depreciation schedule, and it takes them 2 days to complete an analysis, and then we send it to you or your CPA with a summary explaining that 10-page analysis on what is important for you. That analysis is very, we underestimate your tax savings benefit because we want to be heroes. We want to overachieve, and we always do that. I don't think I've ever missed a tax benefit that we proclaim that we would get, and we always far exceed it. But what we need for that analysis, to answer your question, is the depreciation schedule, or if they just purchased it. Sometimes I have some commercial brokers that will say, my client's looking for multifamily. These are 2 or 3 of his options. Will you give me 3 different, will you give me an analysis on each one of his tax savings benefit if he purchases it this May 2020, and we'll run an analysis and we'll give it to the commercial broker or the multifamily investor, so he can see, wow, when I get this property and we get this back on and a tax benefit with the 100% bonus added to it. Wow, that's great, and I can make these repairs. I can, make these changes that I need to do to pick up the property.
Boy, that's a great point. That's a great tool for all the brokers out there that may have clients that are interested in multifamily but can't quite make that jump. If they can provide a cost segregation study for that client prior to the purchase, that might convince a lot of folks. So that's a good idea. What about you had mentioned prior to the show ways in which we could be proactive in prepping our 2020 tax return in relation to cost segregation. I was wondering if you might be able to elaborate on that a little bit.
Sure, and I don't want to miss the fact that banks love the fact when you're going for that loan or whatever, to mention to them that you're going to do cost segregation, because that is actual cash flow in your pocket that they're hoping that you're going to get. So that's really important.
Okay, good stuff.
So an exciting new thing that just happened 2 weeks ago. Finally, Congress extended what's called 179D, and that's for commercial energy efficient buildings, but 45L is for, and they just extended this, it's been in limbo for a few years, for energy efficient buildings. And that would allow an apartment person or home builder, whatever, in the multifamily, to get a $2,000 tax credit for every new energy efficient dwelling unit that they have occupied.
Really?
So you can,
okay.
You can go back to 2016 and find out what your, if you would apply, or if there's a way for you to grab this tax credit.
Okay.
So, sometimes it's in the insulation, sometimes it's your roofing system, your window. There's many different ways that you can qualify for that. So you need to really look at your taxes at the end of the year. First of all, did I have any repairs or renovation? Secondly, my depreciation schedule. Is this a possible cost segregation opportunity? Number 3 is almost critical. do I need to reverse any items that have been capitalized in the past on this depreciation schedule that now, according to the new regulations, have to be written off? And they will go back. If you haven't scrubbed your depreciation schedule and you're audited, the IRS will disallow those items. So they're not joking right now. I've seen plenty of audits with that occurring. And then just be strategic. Know the different repairs and renovations that you faced, and do it with the safe harbors, the tax benefits that are out there. Make sure that you're using the safe harbors. That's all you need to know. Make sure your CPA knows that you want to be strategic with your properties so that you're keeping them in the best shape and that you're getting the most tax benefits possible.
I love it. I mean, I'll tell you what, this is one of those episodes where I feel like I could go back and listen to it 3 times over. And with all the little tips you've given, just make notes and make notes and make notes, and then take those notes to your CPA, or just look at your own tax return from the past year or two and see what you have applied or not have applied. And you're not going to get it figured out in a day, but ultimately prepare your tax situation moving forward. So beautiful stuff. Now, having said all that, what is the best way for our listeners to learn more about you or contact you should they have any questions or interest in performing a cost segregation study?
And even if they don't want to perform a cost seg study, they don't want an analysis, if they would like just like a quick information sheet, I probably have 1 or 2 or 3 that I could email them on just how to become familiar with these regulations so they're maximizing their tax returns. It's something I give to the CPAs so that they're doing this for their clients too. They can contact me at Linda Martin, and my phone number is 815-260-2943, or an email is Linda CostSeg. Linda COSTSEG, CostSeg, at sbcglobal.net.
All right. Wonderful. Well, Linda, thank you so much for being on today's podcast. You shared a ton of information. I think the listeners will find it very helpful. And we look forward to having you back down the road just to share some additional ideas. I think it'll all come in very handy.
Well, thank you. It was great having this discussion. I appreciate it.
Yeah, you betcha. So that'll conclude this week's episode of Landlording for Life. Thanks again to everybody for tuning in and listening all the way through our episode. If you like what you hear, leave us a 5-star review. Otherwise, we'll see you next week on the next episode of Landlording for Life. Bye-bye.
Thanks for listening to another episode. If you like what you heard, leave us a 5-star review and join our Facebook group to share your deals and ideas by searching at Landlording for Life. See you next time.